So for the third quarter of 2017, the overall market compared to last year, our sales are trending slightly down from last year. And that probably has more to do with squeezing of inventory. There isn't as much to buy. But also, interest rates are slightly up, or at least steady, and values are up. So that with a slight increase in interest rates and value increase, that affects affordability. So that takes a few people out of the market that could afford a home, so that reduces demand a little bit. So that combined with tighter inventories. And also, in general, it shows that there's a general momentum softening of the market in general. That's really across the country, not just in Michigan. And that's as much because the pent-up demand for the recession is finally starting to settle back. We're settling into a more normal market. The good news is income growth is finally starting to rise a little bit. Job prospects are strong and have been. But we're still in a average moving economy, so we wouldn't expect it to necessarily, over the next couple of years, take off. Demographics are still good. Gen X and Gen Y are a huge population of buyers and sellers in the market, as well as baby boomers. So that mix is on a long-term basis for the next few years is very strong. But short-term, we can probably expect to see not the same type of housing activity we saw in 2016 and 15 to be settling down a little bit. In Michigan, for example, we look at auto sales. And auto sales are seeing that same tapering, that same settling down. And of course, in Michigan, where auto goes, that's where we go. We tend to follow that. So that's the overall direction for Michigan. For Southeast Michigan, looking at the results from the third quarter of this year compared to last year and the first half of the year, and we break the market up into the usual three segments we talk about, the under 250, 250 to 500, and over 500. The trends have been about the same. The under 250, though, we're seeing that the inventory decline is not declining as fast, which is the first step in the trend towards maybe even rising. So there's sort of the good news. But sales have also been declining in that segment as well, because there just aren't as many homes to purchase, so it's being squeezed. And we're also seeing, as values are rising in that lower segment, and the home value rises are strongest in the under 250, those homes are actually then graduating to the next segment, the above 250. So it's winding up squeezing that inventory. In the middle market, inventories are also declining, but again, not as fast. Sales are starting to settle off a little bit, but values are still rising, so it's still a strong, active segment. In the over $500,000 market and the upper end market, we're seeing that inventories are not declining as fast. They were rising rather, for the last couple of years. They've actually started to decline a little bit, taper off, so that rise in inventory, which is causing values to actually decline back in 2016, that's helping a little bit. So values aren't really declining in the upper end, but they're very flat. And the reality is that if you have a home on the market in that upper end more than about 30 days, on average, you can expect a price correction necessary of about 10%, and the homes in the market there are going on for almost 4 months. But right now, if you think of all three segments, the trends have been consistent. The under 250, the lower price segments, still very strong, but settling a little bit. The middle market also very strong, again settling, and the upper end a little weaker. Values not really rising. Expectations of buyers and sellers are different in each of those segments. So if there ever was a time when you needed a realtor or professional to help you through the process, it's now, because the market isn't moving all in the same direction. So that's it for third quarter of this year.